Great. Good evening, everyone. Thank you for making the time to join this webinar with us today on a weekday. We have an incredibly interesting opportunity for our users, and we are also hosting, one of the most, one of the oldest microfinance institutions, a promoter with us today. So we would love to dive into that very quickly with you all. I'm joined by, just to introduce the panelists, I'm joined by my colleague Rishabh, who leads credit for GRIP. Also Ms. Sucharitha, who is the promoter and executive director for SHARE Microfinance, the originator for our LoanX transaction. And my name is Siddharth. I'm the Chief Investment Officer for GRIP. And the three of us will take you through this opportunity today. We will kick off with talking about very quickly a quick recap on GRIP and the LoanX product. Dive into the the originator's journey, SHARE Microfinance journey, and then speak more about the opportunity in detail. Towards the last 10 to 15 minutes of the call before Q&A. Quick recap. GRIP is an investor-first, transparency-focused investment platform that offers alternative fixed income investments across a few different products. You have come to know us for almost 4 years now, and we hold a couple of SEBI licenses. We have enabled nearly 1,000 CR in transactions from more than 26,000 investors, and return almost a little over half of that capital back to our investors with next to negligible default rates. We are also backed by some of the very well-known venture capitalists in the ecosystem. GRIP offers a quick recap of the products we offer. So, really, we have 4 key products, across the risk-reward spectrum. So that's across the rating, the rating grade, as well as the reward. Towards the higher rated papers, we offer corporate bonds and our NBFC product. Towards the middle range, we offer LoanX, which is the opportunity we'll be talking about today, and then towards the lower end of the rating curve and higher end of the risk curve, we offer our LeaseX product. These are products that you have all sort of been familiar with, but essentially they're all securitization products, securitizing either NBFC receivables or operational lease receivables from our lessees. We have enabled almost 260 crores of investments in securitized debt instruments, and we have truly pioneered the asset class. Out of this, almost half of these investments have come through our LeaseX product, where we securitize operational lease receivables to lessees like Blue Smart, Zip, Everest Fleet, and several others. The balance half, a little over half, has actually come from securitizing NBFC receivables. And these NBFCs operate across the board, across asset classes, whether it's microfinance, LAPs, education loans, vehicles, invoices. So it's a pretty diverse group of NBFCs, and nearly 75% of the opportunities that we bring for our users are rated investment grade, including the one we'll be talking about today, by the top 3-4 credit rating agencies. I'll quickly move on from GRIP and talk about LoanX as a product. Again, some of you might already be familiar with it, but for those who are not initiated into the product yet. So LoanX essentially allows investors to earn fixed monthly returns by lending money to a diversified pool comprising of loans given to multiple individuals or businesses. And these are identified. These loans these borrowers are identified and underwritten by typically by an investment grade rated NBFC, and we essentially securitize these loans into an SDI instrument, or what we also call as a PTC, a pass-through certificate, that our investors would invest in. So if you move with me from left to right on this slide, on the leftmost side, you will see a pool of borrowers. The originator, which is the NBFC, gives loans to this pool of borrowers, and in return, they would expect monthly repayment of that loan. From the originator, we essentially cherry pick this pool of loans that originator then assigns to a trust, and in lieu of that assignment, gets money from the trust, and that trust assigns to our users, to you, securitized debt instruments, which are either listed or unlisted securities, and they're all rated. They're RBI compliant, and they are in cases where these are listed transactions, they're also SEBI compliant. So the capital flows from you to the trust, from trust to the originator, and the originator issues the instrument to the trust, and the trust in turn issues the instrument to our users. And typically these are fixed income instruments that pay out every month. This asset class, the PTC asset class, is incredibly large. In FY23, it stood at 1.76 lakh crores, largely dominated by institutional investors, and in FY24 it grew to almost 2 lakh crores. And this data is according to CARE ratings. It has seen almost a 30% CAGR over the last 3 to 4 years. And we essentially invest in the same paper as many of these institutional investors that you see on the right hand side of the slide. And so we bring the same level of institutional quality in the paper to our users as any of these investors would also invest in. Quick highlights of LoanX. So it's a pool of cherry-picked loans that's diversified across personal or microfinance or vehicle or MSME loans. This pool typically performs better than the NBFC's overall portfolio. So and that's what makes the product really, really exciting. All the loans are, as you mentioned earlier, are originated usually by an investment grade rated NBFC. We would typically target, depending on the rating of the paper, anywhere between 12 to 14% return. That's your yield to maturity or IRR. And usually these are, for similar rated corporate bonds, these papers are typically at 100 to 250 basis points spread in terms of better yields than similar rated corporate bonds. They pay out fixed monthly interest and principal in most situations. They are secured by what we call as over collateral or cash collateral, and that's really the originator's skin in the game. So if we were to buy, let's say, if there was 100 rupees of pool of loans, and there would be a component of over collateral, and let's say if the over collateralization was 10%, the pool we would actually invest only 90, and the balance would come from over collateralization. So it almost acts as a buffer in the deal, and sort of internal security in the deal. Then there is also cash collateral, which is put in by the originator, and together the weighted average security cover in a deal ranges anywhere between 30 to 60% over the life of the deal, including the over collateral and the cash collateral. There is also, RBI, given RBI's securitization norms, there's also no reliance on the originator. So these are bankruptcy remote papers, while the originator, of course, has originated the loans and will continue to service them. But otherwise, there is, given that there is upfront security from them, there is no other reliance on the originator. We already spoke about the fact that these are both RBI and SEBI compliant with RBI and SEBI regulations. These units are also held in your demat account. So there's ease of acquiring these units, and the taxation is only the interest part of the, like you will have in bonds, corporate bonds. Only the interest part in the loan is taxed by tax at your income tax rate. If you can go ahead, please, Rishabh. Here's a quick snapshot of recent coverage by Mint on our LoanX product. You'll see on the slide towards the right hand side of the slide, there is a risk matrix of risk return risk matrix. LoanX was positioned as at the lower end of the risk, as you will notice, but in terms of returns, it was positioned in line with Nifty 50's long-term return profile, right? So again, it's an incredibly provides an incredibly attractive risk-reward proposition. If you could please go ahead, Rishabh. Great. So we'll now dive into the recap of GRIP and LoanX as a product. We would dive into SHARE Microfinance, which is the originator for this LoanX transaction, and we are joined by Ms. Sucharitha, who is the executive director and promoter of the NBFC. Thank you so much, Ms. Sucharitha, for joining us. We would love to learn a bit more about SHARE Microfinance's journey, and while we have, of course, some content up here, but it's been one of the oldest MFIs in the country, massive scale in more than 18 states, 720 branches, investment grade rated. If you could talk about how SHARE Microfin came into existence, the ethos and the focus, that would be wonderful.
Siddharth, thank you for that kind introduction, and I also congratulate the GRIP team for this interesting business model, which is quite exciting for any retail investor. Yes, I'll introduce SHARE, and we are an NBFC MFI. We started our microfinance journey way back in 1989. That's about 35 years of experience in financial inclusion. Over all these years, we have cumulatively disbursed about 26,000 crores to about 56 lakh women borrowers. Most of these borrowers, women, come from rural India. That's 87% of these borrowers are from rural India, and our focus has largely been on the rural women folk in our country. We have also, I think, done a great job in training over 22,000 individuals in microfinance, and we believe that is our contribution to the microfinance sector in general. Being one of the first MFIs in the country, we also bagged many other firsts through this journey. We were the first, in fact, who's done a securitization deal of unsecured portfolio. We were the first to get graded the highest in microfinance. And we were also the first to attract the largest equity during 2007. Also the first to do NCD. So we've set a trend, I believe, in the sector. The other side of the coin is, not just being first in great things, but also experiencing several challenges. All through this journey, we've come across several challenges, be it Krishna district or Kolar district crisis, the AP MFI crisis, COVID, demonetization. There were several. But one feature of SHARE is we've never given up. We have been persistent towards our vision of serving our clients, and we emerged successful from all these events, which hit the sector and even SHARE to a large extent. And the biggest shake we had was the APMFI crisis, but I think in 2023, we repaid all our dues to our lenders, that too at an interest rate of 12%, 13%, which were all commercial rates. So that, I think, is the biggest success of SHARE. The strengths of this company, I would say, are threefold. One is our systems and processes. These are all time-tested, refined over 35 years of microfinance experience, and powered by robust technology. We have mobile app for our staff, mobile app for clients. There is real-time decision making, real-time triggers, all of this attributing to strong controls within the system, which again translates to the kind of quality portfolio when it comes to our outstandings. The second pillar, I believe, is our teams. Each of our team members is experienced. The average vintage of our 2,600 plus staff members is about 5 years, which means that our teams are passionate. We love what we do, and they've been with the company, so they understand the systems, they process applications the way they are expected to, and their analysis of a client to whom we are going to lend is also, experience based. And the third strength we believe is our network, huge branch network. We were once upon a time almost at 2,000, close to 2,000 branches. We've consolidated that after the AP crisis and now stand at about 700 branches across 18 states. On size, just our presence, we would rank amongst the top 12 MFIs in India. So with these three strengths, the systems, the processes, the teams, and the network, we believe after the transaction that we concluded in March 2023 that we are set to get back to where we were prior to the crisis, which is somewhere on the top in the NBFC MFI space. Last year was almost a rebirth of SHARE. After the March 23 payment, we were able to tie up almost 1,400 crores from various lenders, banks, NBFCs, small finance banks. We were also able to disburse or access 1,000 plus crores during the last year in various formats: term loans, securitization, PTCs, direct assignment, business correspondent. And just last month, we have been rated by ICRA BBB minus stable, and they are also achieved the rating of COCA C1, which talks about, which is the highest on a scale of 1 to 5, which is the highest. And that is done by SMERA ratings. All this speaks about the strength of the entity, which is its systems and processes and how good our collection efficiency is. That is, we are at a 99.45 collection efficiency, which means that for every 100 rupees that is lent to a client, the maximum risk that we have faced right now is about 50-55 paisa. With this backdrop, we have huge plans. We would like to almost grow at 100% growth rate. We want to cross that 1,000 crore AUM by this year end. We are currently at a 550 crore. Before the Andhra crisis, we were a 5,000 crore AUM entity. We've already traveled that journey. So we believe that, we can do that on a much more easier front. Yes, much has changed, market has changed, but we also have I would say, evolved with the market, and we would love to achieve that 1,000 crore AUM by this year end. The infrastructure that we have, the branches, the staff are in place, and we are hungry for this growth, and all we need is funding. So that's where partners like GRIP, partners like our banks, our NBFCs and SFBs come into the picture. And with this in place, we are confident of achieving our growth plans. A little bit on the pool itself, on the transaction with GRIP.
Sorry, maybe Sucharitha, I can just chime in here. We will get to the transaction in a couple of minutes, but maybe perhaps we could spend a few more minutes on the originator, and I would request Rishabh to go back to the first slide of this section, which also had a bit more information about your key lending partners. Maybe you could, talk a little bit about. We can see some of the most institutional lending partners, their logos on this slide. How have your, over the last 12 to 18 months, how have some of these lending relationships been forged, and how has your and what's sort of the way forward with some of these lending partners? How are you looking to diversify that base? And given that institutional lending partners on a balance sheet always gives everyone a lot of comfort.
Sure. When we started off the year, after the March transaction, it was IndusInd Bank and Manavia, just two lenders. Manavia, which is the ICO Credit, Indian wing of ICO Credit. IndusInd had taken an exposure of 367 crores, one huge exposure, and Manaviya started their first term loan with about 25 crore. From there, we have, I think, done an excellent job because SIDBI and ICICI, who were earlier as well with us, they were with us. They've been with us for over 20 years now, and they continue to be with us, each of them on the business correspondent model, almost about 100 crore exposure. So I think on diverse lenders, last year we had to depend more on NBFCs. Last year being the first year almost for SHARE after a milestone transaction. But this year, we would like to focus more on, garnering support from banks, which would reduce our cost of funds going forward. NBFCs tend to be a little more expensive. But at the same time, the kind of growth that we want to achieve, NBFCs are faster in decision making. Even models like PTCs and direct assignment, these are, funding that is more easier available. So for now, our funda is growth. So to achieve that, while our sweet spot would be term loans from banks, we are keeping all options open, be it NBFCs and be it various models, be it term loans, be it DAs, be it securitization, and be it business correspondent. Or utilizing all these sources, hopefully a larger base of banks, we would, I think, achieve that 1,000 crore mark by this year end.
Yeah, absolutely. And I would just like to chime in here. We have had the opportunity to work with Ms. Sucharitha and the entire SHARE Microfinance team now for the past few months. And when we started working with them on a transaction, just right around the corner, they did a couple of large PTC transactions. One was a direct assignment, the other one was a PTC transaction with with the likes of Annapurna Finance, Mass Financial, who are incredibly well entrenched in the securitization market and understand SHARE's business model, the risk reward, the pools, and so on and so forth. So I think that's something that we have seen the SHARE balance sheet grow over the last few months, and they've sort of gone from strength to strength. I would like to focus a bit on the Rishabh, on the pages, on the numbers on the following page, or actually the page after this one, where Ms. Sucharitha did mention earlier that there's still an NBFC with they only have with 720 branches with nearly 2,700 employees. A lot of these branches and employees have been with the NBFC for now several years, and in spite of certain sluggishness due to the AP crisis, which was a systemic crisis, it wasn't a SHARE microfinance crisis. They continue to maintain a large collections team, dispersal team, which I think which adds a lot of operational leverage as the AUM grows and the revenue grows. A lot of these costs are fixed costs, and they would result in a significant upswing in the profitability of shares numbers. So maybe if you could elaborate on that a bit more and take cues from that, Sucharitha, and share your thoughts on that, please.
Yeah, absolutely. So prior to the crisis, the Andhra crisis, we almost managed a 5,000 crore AUM with about a staff base of close to 13,000 individuals. We had to consolidate based on where we were leading to, and based on to ensure that we keep our expenses in control. But we've never let go of any of our staff members. There were options available, and there are choices. It was their choice whether to leave or stick. But I'm so happy that most of them, almost 2,600 people, have been with us. They are passionate about the company. They love what we do. And beyond that, wherever we are right now, the expense, the OPEX is on the higher side, because of the portfolio is much smaller compared to the infrastructure that the company has. 720 branches is a huge infrastructure for a company with an AUM of 550 crore. A 700 branch entity can manage almost 3,000 to 4,000 crore AUM. but we would looking at it at an angle of the kind of growth that is achievable with this infrastructure. This 720 branches can manage a 3,000 crore portfolio with no additional cost. That's where the OPEX, the coming down of OPEX, is something that we will achieve. So going forward, the plan of reaching our 5,000 crore AUM, what we will be looking at is better returns for the investors, for the shareholders, and of course, a reduction, a coming down of the operating expenses. There will not be much of increase in OPEX because the infrastructure is already in place. It is more of utilizing the infrastructure and continuing to grow our business with the right kind of funding partners in place. So that's what makes, I think, partnering with Share quite exciting.
Great, and I would just highlight a couple of numbers. We do, by the way, see certain questions coming through on the originator, and we will dive into the Q&A, very soon. But I would like to highlight, per branch AUM of 80 lakhs. They are now PAT positive. The debt to equity ratio is 0.4, which is incredibly low. The net worth is still, north of 200 crores. We already spoke about low gross NPA and high collection efficiencies. So I think these are a lot of the factors that give us internal credit as well as the rating agency a lot of comfort. If you could move on, please, Rishabh, and we can now dive into the opportunity itself. So Rishabh, I'll request you to speak about the opportunity during the next 7 to 10 minutes, and then we can dive into a Q&A.
Sure. Am I clearly audible? Thanks a lot. Thanks a lot, Siddharth. Hey, hi, good evening, everyone. Let's dive right into the opportunity that we have in hand with SHARE Microfin. So it's a A-rated LoanX opportunity that we have on our platform, right? And it's rated by ICRA. So the transaction is backed by a pool of 3,600 plus JLG loans, which are joint liability group loans. So JLG loans, I'll just touch upon this briefly. JLG loans is wherein the MFI loans are granted to borrowers in the tier 2, tier 3 cities in group formats. This is one of the best and most reliable format of disbursing loans in the low income group and is followed by most prominent NBFCs in the country. So the transaction has a tenure of 15 months, and you can see that the weighted average deal tenure is 7 months. And this is certainly quite lower than 15 months, obviously, because all the money that you invest in the deal, which will not stay invested throughout the tenure of 15 months, and it keeps on amortizing, therefore resulting in a weighted average deal tenure of 7 months. This deal comes at a pre-tax IRR of 12.5%, has monthly payout structure, wherein principal and interest will be paid out monthly, and is already, as I mentioned, is a granular pool of 3,600 plus borrowers. Now let's talk about the security package that we have in the transaction. So there are 3 security components. One, there is an over collateralization cover of 12%. And I'll not deep dive much into this because Siddharth already explained how over collateralization works. Then apart from it, we have a cash collateral to the tune of 5%, which is again in form of liquid FT lien and is always available in the transaction. And the third component is EIS, which is exit interest spread. And it also provides an extra stream of liquid cash flows in form of interest and is always available in the transaction. Then we've already spoken about SHARE Microfin in detail. So let me move ahead and talk about why we really like this opportunity. So this opportunity, as we have mentioned, is originated by SHARE Microfin, which recently has got BBB minus rating by ICRA, which is investment grade rating. And it has a monthly payout structure, and it comes at an attractive risk reward. And we will talk more about it when we move to the further slides, how it compares to the previous transactions done by SHARE. Then let's talk about the pool. It's a fairly granular pool with a good vintage. In other words, the borrowers in the pool have completed 6 loan cycles with SHARE Microfin on a blended average basis. The borrowers have seen a vintage of 5 months. I mean, it's the seasoning, which we call it a seasoning, is 5 months for the pool, which is 21 weeks, and there have not been any defaults for the selected pool. It's a fairly diversified pool and quite granular with average ticket size of 36,000 per loan, which means that if you are investing 1 lakh in this transaction, you are only exposed to 30 rupee per loan. That's because it's diversified. So now let's talk about security cover. Because of the security components that we have in the transaction, on an overall basis, the weighted average security cover is 1.5x nearly. And because of the security cover, 61% of interest defaults will be fully covered. And if the pool, which is the underlying borrowers, if they default to the tune of 21%, which is a very high number, obviously in the context of the NPA of the company. So if the pool defaults by 21%, then also the investor returns will not be impacted. So that's why this is a very interesting opportunity. We'll quickly cover this. So if we compare this opportunity to other similar rated bonds in the market, then you can clearly see that this transaction has a 1.2 to 1.7% higher returns.
And I would also add that it's at a lower residual maturity. So it's expected to be a 15-month transaction, whereas most of the bonds you see here, be it Euroclicks, Navi, these are all 18-month bonds.
Yes. Okay. Moving ahead. So of course, because this is a amortization structure wherein the principal and the investment amount is getting amortized every month because of the principal and interest payouts. Therefore, you would see that the going in security cover will keep on increasing in percentage terms, and in 10th month it will be 100% equal to the investment amount. And as the instrument amortizes further, this will increase, the security cover will increase multifolds to 1000% as well. And we already spoke about, and that is a 1.5x security cover, and your investment will be fully protected.
Sorry, when Rishabh says your investment will be fully protected to the extent of the security cover.
Oh, of course, yeah. It's my bad. Sorry for that. Yeah, it's 1.5x security cover. Now let's talk about the underlying pool in the transaction. As we mentioned, it's a 3,600 plus loans diversified across 15 states and 242 districts, with the highest exposure being in Bihar to the tune of 15% of the pool, and followed by MP, Odisha, and Chhattisgarh. To reiterate, there is no exposure in Andhra Pradesh in the pool as well as in company's portfolio. The average ticket size is 37,000. The weighted average seasoning, which is the track record of the borrowers in the pool, is 21 plus weeks. And the borrowers have seen 6.3 loan cycles on an average basis with SHARE Microfin. Now, let me quickly cover how this transaction compares to the very recent PTC transaction / SDI transaction done by SHARE Microfin. So our transaction is of the similar loan pool, which is JLG loans. This is the subset of microfinance loans, and has a higher seasoning, which means that the previous transaction was 22% amortized at time of securitization, and going in, this transaction has 27.5% amortization. Is more granular because the average ticket size is lower, and concentration in top 3 states is also lower. Because of all these factors, coupled with similar security package, this transaction has a higher rating of A as compared to the previous transaction, which was A minus. Moving ahead, let me briefly touch upon how the waterfall or / the repayments in the loan will look like. Because of how the transaction is structured, all overdue and current monthly interest payouts, along with the promised monthly principal, will be paid on priority, and cash collateral, which is FD lien, will be replenished as well. So that's about the transaction. Over to you, Siddharth.
Great. Thanks a lot, Rishabh, for taking us through that. Is there anything, Mr. Sucharitha, you would like to add perhaps to this? Otherwise, we'll dive right into the Q&A, and I do see a bunch of them with us already.
Yeah, I think to add on the direct assignment that we did, which is kind of similar, has a flavor of the securitization or PTC that we are talking about. That was a 356 crore pool. And in that, the credit loss was 0.05%, which is
This
almost...
was with Annapurna.
This was with the IndusInd Bank.
IndusInd Bank, okay.
So, 0.05%, almost negligible. And this is not actually credit loss. This is par, which means that, it's almost nothing. So you can imagine, out of 628 crore AUM, if 356, majority of it was performing at that excellent performance. This is a cherry pick, like you said, the 11.8 crore. And beyond that, there is so much of collateral or security available for, you mentioned about 23%, 26% of, security that is, so, the loss is almost nil. It's almost, you're fully protected against any, downside. So I would say it would be an excellent opportunity for any investor.
Great, thanks. And that's maybe that's a good segue to a couple of questions that do talk about underwriting and collections. So maybe I'll open with a couple of questions to you, and I'll club them together. Sucharitha, I think the first one is, how do you underwrite joint liability group loans? And I think one of the questions I could club with that is, typically at what rates do you lend? And maybe we'll start there and we'll come back to a couple of other questions. Can you hear me well?
Yeah. So on the underwriting bit, we work only with women for microfinance product. Largely our entire product, or what we do on our own book, is JLG loans, the joint liability group loans. The process starts with an orientation program where we explain to the clients what is expected, what is the loan that we are going to offer, because this is quite a sensitive market. Many of them are uneducated, many of them cannot read. So it's almost a training that happens for 3 to 5 days. It is called compulsory group training, where the product features, what are the expectations, what, there will be a credit bureau check, what are the implications of that, what are the implications of not repaying on time, all of that is explained. After the compulsory group training is done, the next step is a group recognition test, which is normally done by a branch manager. The training is done by a credit officer, and then a branch manager performs a test where he asks questions, and the group is expected to respond. And if he's satisfied that the group has understood their liability and their expectation from them, that is to repay on time, then he passes them, and that's when the process starts. There is a credit bureau check wherein every client's score, every client's history of how many loans, what is the credit outstanding with other institutions, what are if any defaults, then what were the defaults, what is the size of total outstanding, the FOIR ratio, all of these are inputted into the system. Along with this is also the household income. That is not just the wife, the client, but her spouse and any other earning member. How much is the earning capacity of the household? Because these are all small households that we are looking at. It's not just the client that we check. We also check on the spouse who is almost a co-borrower. Woman, the place of a woman in the society is also that she's quite active in the household, and the husband also. It's important that the husband also understands that she's taken a loan and the family is responsible for it. So the credit check is done both on the client and her spouse, and the household income is another parameter that we take. These all are run through our business rule engine. So this is all driven by technology. With the eKYC check that is done through the Aadhaar number of the client, or the KYC of the client and the spouse, Then the BRE runs checking the credit worthiness, where all these parameters, that is the credit bureau, the outstanding liabilities, the household income parameter, and then the overall FOIR ratio, how much is the obligation, including the expected loan that we are going to disburse, and whether it is less than 50% of the entire household income. These are all as per the RBI guidelines. We are 100% compliant with the RBI requirements as well for the JLG loans. And once a client passes, then it goes on to the next process, which is documentation. The other feature that is very peculiar to share is, for a disbursement, the client comes to, along with her spouse, to the branch, because we believe that the client should know the physical location, and that also improves the connect with the client, and the branch manager, in presence of a senior who is an area manager, confirms the disbursement, and then the disbursement is done through centralized NEFT transfer from SHARE's bank account to the client's bank account. So that's in a nutshell. There are various series of, it's quite, the entire process takes, for a new client, takes about 7 days, including the training and the group recognition test. If it's a renewal client, the client already has a connect with the company. She understands the processes. So it's more of a BRE, the business rule engine checking where she is, checking her past performance on her outstanding loans. And then it's a much faster process, which is concluded within a day sometimes, and at the max within 2 days.
Okay, great. Thanks a lot. That was super helpful. Could you, we don't want, maybe we can spend a couple of minutes on it. In 2010, could you add a bit more light on the AP crisis, how it was a systemic one, and what sort of it meant for the industry? And related to that, perhaps the question is, what if there is another such crisis? Now, maybe I'll say that there are certain risks in any market, which include a systemic risk like an AP crisis, or it could be a monetary policy risk, or a fiscal policy risk, or any even a force majeure like a COVID. But if you could, so those really sort of edge cases do exist, and I think they're far and few. But if you could just talk a little bit about the AP crisis, and also maybe how were your collections in COVID, that would be very helpful.
Yeah. So in 2010, we were a large MFI. We were going towards an IPO. The largest of the MFIs were based out of Andhra Pradesh, the top 4, in fact, the only 4. Microfinance as a sector was not as recognized or not as popular then. There was no category called NBFC MFIs. We were all graded as NBFCs. And I think the general awareness on microfinance, the processes, the systems across, wasn't as much as it is in the current day. But at that time, because most of these MFIs started and originated from Andhra Pradesh, the United Andhra Pradesh, which is now Andhra Pradesh and Telangana, since most of the portfolio was here, there was an act called the AP MFI Act, which was introduced by the then AP government, which basically posed several restrictions on the operations of AP MFIs. It basically meant that there were limitations on our disbursements to clients. We almost had to get approval for every loan that we were to disburse to a client, number one. Number two, we were unable to meet our clients. See, all the collections in an MFI happen at a public local meeting on a weekly basis. So clients of groups of 40 meet at a place where they choose, and that's where we collect. We make the repayments, the weekly repayments. But this act posed a barrier for even those meetings. So which basically meant that we could not go for collections, and that basically meant that all our collections were frozen from the state of Andhra Pradesh. So at that point in time, the exposure that SHARE had towards this Andhra book was about 35%. But RBI was very proactive. I would, we should thank RBI for their move, because this happened in October 2010 when this AP-MFI Act came in, and Jan 2011, RBI issued a circular stating that these are issues that are afflicting the sector, not because of any credit weakness, but it is largely because of an external circumstance. So they urged the lenders. We almost had 49 banks, financial institutions, NBFCs, various lenders who had funded these institutions, the large one among them being SHARE. And RBI gave a lot of comfort. They gave comfort to banks to be able to support us. And so with that support from the regulator and the lenders, we were able to move on. We were able to pass on. It is only because of the strength of operations, even though 35% of our portfolio was stuck in Andhra, not able to recover, not able to disburse there, literally not being able to do any business in the state of Andhra Pradesh. We were still able to survive, repay everything to our lenders in full, and emerge successfully. And I think that's the success of the entity displaying its strength in operations and trying to absorb all the effect and impact that the AP Act had.
Great. No, thanks. Sorry, go ahead.
On COVID, you also mentioned about our performance during COVID. I think SHARE is one of those entities which did not take any write-off for COVID, which almost when in 2020 we had a portfolio close to 700 crore, and when COVID hit, of course, we were not able to meet our clients. There were lockdowns all across the country, and our collections happened through meetings. But the connect with our clients, SHARE's clients, we've been the first lender to most of these 56 lakh clients that we worked with. So there is a connect, there is a loyalty, which client loyalty, which we have, I would say, which we cherish the most. And that comes across in our experience during COVID, because we have not written off any amounts. We have recovered out of 686 crores. The only outstanding amount is about 14 crore. Every other money, along with interest, was recovered, which means that again I think is a testimony to our connect with our clients and our abilities and our processes.
The prudence of women borrowers, perhaps.
Perfect.
Yeah. Okay. And typically, one of the questions was the rates at which these JLG loans are provided. These are typically in the mid-20s. And they could be anywhere between 12 to 18 months in most instances, or 15 to 18 months in most cases. Is that right?
Our loans are between 12 and 24 months. We see our cost of borrowing is dependent on NBFCs and banks. So we lend at about, on an average, at about 24%. If our borrowing cost is at about 12, 13, whatever percent, there's again operating expenses that have to be covered within this 24%. So after that, a margin of about 1-2% is what I think largely MFIs.
Sure.
And then there is, of course, a credit loss that you have to be prepared for in case of any worse circumstances.
Sure. Okay. Maybe I can take this one. One of the questions is, if you can share more information about the collateral that we provide for this in this pool of loans. So just to be clear, the underlying loans themselves are unsecured, right? These are microfinance joint liability group loans, and these are unsecured loans. Having said that, this transaction does have a security package that entails an over-collateralization of 12% and a cash collateral of 5%. And as Rishabh explained earlier, or I think I did so, the over-collateralization is in a way an intrinsic security in the structure, wherein if there is 100 rupee of a pool of loans, and we are paying, in this case, 88 rupees actually, with the 12% over collateralization. And so we're paying 88, but we're getting loans worth 100. And there is also excess interest on those 100 rupees worth of loans. So that's the intrinsic security. The external security is the cash collateral, which is in the form of fixed deposit, and the trustees, and it's earmarked to the trustee, and that only gets paid back to the originator once the PTC has been fully repaid to the investors. Okay, moving on, there are a couple of operational questions here. What's the minimum ticket size? A ticket size is close to 1 lakh rupees. Please do check out the link on the platform for it. What do you do if borrowers won't pay loans taken? Maybe that one's for you, Sucharitha. I think I would again reiterate that the collection efficiency is north of 99%, 99.45 to be precise. Having said that, there is always a risk with the borrowers delaying their payments, and maybe you can talk a little bit about the feet on the ground and the collection team and what steps they take to encourage borrowers to pay on time, including any incentives that you might offer.
Yeah. See, like I said, there's already, before even disbursing a loan, there is a training of 3 to 4 days, which is mandatory. And we ensure that the client understands the impact of non-payment, which is an impact on her credit history, and which further impacts further loans from not just SHARE, but from anybody else in the sector. While that is, one measure, but these are all joint liability groups, which means that every person in the group is guaranteeing on behalf of the other client. So if a client has an issue, it's not just the client. Even in the loan documentation, all the 5 members of the group sign off the agreement saying that, almost guaranteeing this one loan of, their fellow borrower. So it's not one borrower, it's 4 other borrowers who pitch in case. And we've seen the strength of the JLG. That's where the recovery rates also are quite high. The third we do is, every loan that we disburse is for a business purpose. It is not for a consumption purpose. It is for an income generating purpose. And after a disbursement is done, there is a process called loan utilization check, which is performed by the loan officer. So that's done within 30-day period after we disburse a loan. And after the check is done, it is quite clear, and in most cases, the client knows that if she fails the loan utilization check, then the chances of getting a next loan is quite less. So and once she invests into an income generating process, a project, be it a kirana store, a vegetable stall, whatever, the chances of her defaulting also are quite downward. Like I said, we also perform a CIBIL check, which means that these are clients who have a good credit score. They have no defaults whatsoever in the past. And even if it were, it may have been pertained only during the COVID. But at least post-COVID, they would have been a client with on-time payments, not just to SHARE, but to all other MFIs. So, the chances of not being paid. And I should also mention that we also take credit life insurance. That is, if on the case of death of a client, the exposure of the loan is covered by way of insurance. So all risks pertaining to non-payment for a client are fairly covered, and therefore I think the collection efficiency of the company has always remained quite high.
Okay, thanks for covering that. Maybe Rishabh, if you can go to the slide with the P&L. One of the questions I'm going to club a couple of questions together. If you could please talk a little bit about the FY24 results, about there has been a drop in the revenue. There was a drop in, PAT, but I mean, you're still profitable, marginal increase in GNPAs. And these are the things that, the ICRA's rating rationale also covers. If you could please talk a little bit about, these headline numbers, that would be very helpful.
Sure. So after, like I said, March 2023 was a milestone transaction for SHARE where we paid in one shot. It was a bullet repayment of all outstanding dues to our lenders, which was to the tune of 409 crores paid in one shot in March 2023. This was to almost 23 banks and financial institutions because we wanted to be done away with that burden of debt, which was pertaining to the old crisis. After that, it was almost for every lender evaluating a newborn child. It was an entity with a clean balance sheet, a clean, almost, it's a fresh entity, a rebirth for an entity like us. So it took us a bit of time to onboard lenders. Lenders have their processes, their due diligences. We were not yet rated then. So we were just starting the process. So that and our financials had to get audited. So all these processes took us almost, the first half of the year up to September. Every lender's, if I should mention, IndusInd Bank, their due diligence was almost visiting 100 branches of SHARE. So you can imagine the depth of due diligence that was done by each of the lenders, which was time consuming. But I think during the second half was when, the confidence was built. Lenders started joining, and that's where, we tied up almost 1,400 or 1,000 crores, of which, most of it was accessed as well by the company. So I think that time that we lost, the first 6 months of the last FY, is results in this slight dip. To just give you an example, or comparison, in FY23 we had disbursed 920 crores to our clients, and in FY24 we lost the first half of the year, and we were able to disburse about 550 crores to our clients. So that resulted in the dip. But now our rating is in place. We have closed the year with a profit, and we are now rated. We are graded by SMERA and ICRA. So this is where things have turned around for SHARE, and what we are looking at is just growth from here. So I hope that clarifies.
Yeah, no, absolutely. Thanks for that. One of the questions that was asked by users, and I can take that. How has the rating moved to BBB minus? And how do we think about rates in a transaction like this? Maybe the rate that we have for our users. So look, I think given SHARE's journey over the last few years, they had a rating of an official rating of D. They were actually given a rating of higher. They were offered a higher rating of, I think, BB plus at some point, which they did refuse, and they wanted to get an investment grade rating directly, and so they waited for 1.5 years while that journey with all the rating agencies took place. It was also, rating agencies have to follow a regulatory process. It's a semi-compliant process where they can't, in spite of all the good that's happening in the company, they can't necessarily upgrade a company in a short span of time. So that process ensued. Having said that, while SHARE was not rated for a period in the middle, a lot of the PTCs were still getting rated A minus, investment grade rating, what we showed earlier with the deals that they did with Mass Financial. So I think and in this process, the rating agencies do have a shadow rating on the originator and so on and so forth. So I think all the signs were sort of positive. We knew this was a likely outcome, and we took our time to bring this transaction for our users, and for a couple of months we waited for that investment grade rating to come through. I think the rates are competitive, as Rishabh highlighted earlier, with other A-rated bonds, and they're actually more compelling than some of those opportunities. One of the users has asked us a question: what will the return be if you invest, if the capital is returned monthly? The return will still be 12.5%. That's the IRR. So the principal is returned to you every month, and the accrued interest is returned to you every month. So your IRR in the deal remains at 12.5%, and you will not and you unfortunately cannot opt for half-yearly returns or yearly returns. The deal pays out every month, and that's how you will get paid out. One of the last questions that our user is asking is whether they joined a few minutes late, and whether the recording of this webinar will be available. Absolutely. The deal materials are available on a platform. The recording of the webinar will also be available. In case you don't find it, please reach out to your relationship manager or write to us at invest@gripinvest.in, and we'll be more than happy to assist you with it. With that, I think we are already past the top of the hour. We are at 8:05. Thank you so much to our users for joining us this evening. It was power packed. 45-50 of our users that were on the webinar today. Thank you so much, Ms. Sucharitha, for your time. I think we got a lot of clarity, and our users got a lot of clarity. while we had the benefit of listening to your story, I think hearing it from you for a lot of our users would be incredibly powerful, and we look forward to working with you again very soon for another transaction. And thanks, Rishabh, for also taking our users through the materials.
Thank you,
Thank you,
Sucharitha.
Siddharth. Thank you so
everyone.
much. It was lovely. Thanks,
Yeah.
Rishabh.
Take care. Thank you. Have a good evening, everyone.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer related documents carefully.